There's a memo circulating among risk managers at major banks right now. It doesn't use dramatic language, no panic, no alarm bells. Just 3 words repeated in different configurations: private credit, Bitcoin, AI stocks. The memo asks a simple question: what happens when all 3 blow up at the same time? Because here's the uncomfortable truth. Trillions of dollars have flooded into these 3 assets in the last 3 years. Retail investors, pension funds, sovereign wealth funds, even your parents' retirement account. And all 3 share something in common that most people haven't noticed yet. They're all built on the same assumption that easy money lasts forever. Let's talk about what Wall Street is quietly warning about while publicly cheering these markets on. Right now, if you're invested in anything, stocks, crypto, real estate, even a savings account, you're exposed to what's happening in these 3 markets. Not because you own them directly, but because the entire financial system is now wired together in ways it wasn't 5 years ago. Private credit has ballooned to $1.5 trillion. Bitcoin's market cap hovers around $800 billion. AI stocks have added roughly $4 trillion in market value since ChatGPT launched. That's over $6 trillion in relatively new, relatively untested assets. And they're all sitting on the same fault line. Here's why it matters. These 3 assets attract the same type of investor, the same psychology, the same behavior patterns. When things go well, they go well together. But when they break, they'll break together too. And the cracks are already forming. Let's start with private credit. Most people have never heard of it, but it's become one of the biggest forces in finance. Here's how it works. You know how banks used to lend money to businesses? A company needs $50 million to expand. It goes to JP Morgan, gets a loan, pays interest. Simple, regulated, boring. But after the 2008 financial crisis, new banking regulations made it harder for banks to lend. They had to hold more capital in reserve. They had to prove loans were safe. So private equity firms saw an opportunity. They started raising massive funds, not to buy companies, but to lend to them directly. No banking license required, no federal oversight, no transparency. Just private money lending to private companies at high interest rates. And it exploded. In 2010, private credit was a $200 billion industry. By 2024, it's $1.5 trillion. Firms like Apollo, Blackstone, and Ares Management are now some of the biggest lenders in the world. Here's the pitch to investors. You get 8 to 12% returns, way better than bonds, less volatile than stocks. Sounds great, right? Except there's a catch. The private credit problem. Private credit loans are illiquid. That means if you invest in a private credit fund, you can't just sell your position tomorrow like you can with a stock or a bond. You're locked in for years. And here's the scarier part. Nobody really knows what these loans are worth. Because they're private, they don't trade on an exchange. There's no daily price. The private equity firms themselves decide the value. They mark the loans based on their own internal models. So if a company they lent to is struggling, the fund managers can just say the loan is still worth 100 cents on the dollar, even if it's not. This worked fine when interest rates were 0 and money was free. But now rates are at 5%. Companies are struggling to pay back these high-interest loans. And the private credit funds? They're still reporting that everything is fine. In 2023, default rates in private credit were reported at around 2%, but independent analysts think the real number is closer to 8%. That's a 4 times difference. And it matters because pension funds, insurance companies, and university endowments have poured billions into these funds. If the real losses start showing up, it's not just rich investors who get hurt. It's teachers, retirees, regular people. Bitcoin, the illiquid liquidity trap. Let's talk about Bitcoin. just hit new all-time highs again. Institutions are buying, ETFs are launching, governments are even talking about adding it to reserves. The narrative is simple. Bitcoin is digital gold, a hedge against inflation, a safe haven. But here is the irony. Bitcoin is supposed to be the most liquid asset in the world. You can trade it 24/7, no brokers, no middlemen, except when everyone tries to sell at once, because Bitcoin's liquidity is an illusion. Here's what most people don't understand. Bitcoin's market cap is around $800 billion, but the daily trading volume is only about 30 billion. That means if institutional investors, who now own a massive chunk of Bitcoin, decided to exit, there's not enough buyers to absorb the selling. The price would collapse. And we've seen this before. In May 2021, Bitcoin dropped 50% in a month. In 2022, it fell from 69,000 to 16,000. Both times, the narrative was this time is different, but the structure hasn't changed. Bitcoin is still dominated by a small number of holders. Just 2% of wallets control 95% of all Bitcoin. And when those holders move, the market moves. Now add in the fact that Bitcoin is increasingly correlated with tech stocks. It used to be uncorrelated, moved independently, but since 2020, Bitcoin's correlation with the net has hit 0.8. That means not anymore. It's just another risk asset. So when tech stocks sell off, Bitcoin sells off too. Which brings us to the third piece of the Trinity. AI stocks, the valuation problem. AI stocks have been the biggest wealth creator of the last 2 years. Nvidia up 10x since 2022. Microsoft, Google, Meta, all riding the AI wave. $4 trillion in market value added. Everyone wants in. But here's the uncomfortable question nobody's asking. Where's the revenue? Not the promise of revenue, not the projections, actual revenue. Because right now, AI companies are spending hundreds of billions on infrastructure, data centers, chips, models, but the monetization is unclear. OpenAI is reportedly losing money despite ChatGPT's success. Anthropic is burning cash. Even Google is struggling to figure out how to charge for AI without cannibalizing its search business. So the bet is this: eventually, AI will generate trillions in revenue. Eventually. But the stock prices are already reflecting that future. Nvidia trades at 40 times earnings. That's not bubble territory by historical standards, but it assumes growth continues at the same pace for years, and history suggests that doesn't happen. In the late 1990s, Cisco was the Nvidia of the internet boom. It was going to power the entire web. The stock hit $80 in March 2000. Then the bubble popped. Cisco fell to $8. It still hasn't recovered to its 2000 peak 25 years later. Same story with Intel in the 1990s. Same with Sun Microsystems. The technology was real, the companies were profitable, but the valuations were insane. And when the music stopped, it didn't matter how good the tech was. The Trinity converges. So here's where it gets interesting. Private credit, Bitcoin, and AI stocks are all driven by the same force: excess liquidity. When central banks printed money during COVID, that money had to go somewhere. It went into private credit funds promising high returns. It went into Bitcoin as a speculative asset. It went into AI stocks as the next big thing. And now, all three are at risk from the same trigger: rising interest rates. Higher rates make private credit loans harder to service. Higher rates make Bitcoin less attractive compared to safe bonds. Higher rates make high-growth AI stocks harder to justify. But here's the real risk. It's not that one of these blows up. It's that they all blow up together, because they're held by the same investors. Hedge funds that own private credit are also long Bitcoin and AI stocks. Pension funds diversified into all three. Even retail investors through ETFs and mutual funds are exposed to this trinity without realizing it. So when one starts to crack, The forced selling spreads. A pension fund needs liquidity. It can't sell private credit, that's locked up, so it sells Bitcoin and AI stocks, which triggers more selling, which creates a feedback loop. And suddenly, you have a systemic event. The quiet warnings. Wall Street knows this. J.P. Morgan's Risk Committee has flagged private credit as a monitoring concern. The Bank for International Settlements, the central bank for central banks, warned about crypto's integration into traditional finance. The IMF has questioned AI stock valuations in multiple reports. But publicly, the message is different. Banks are launching Bitcoin ETFs. Private equity firms are raising bigger credit funds. Analysts are raising AI stock price targets. Because